There you go. Hey, I think we're going to get started if people could just settle down a little bit. We'll go through the intros while you finish your conversations, and then we'll get into the panel. So let's start on the end. Just introduce ourselves, and we'll get started.
Just get a sound check.
Yeah, hey guys, Anthony Fontana with Vantage Point Acquisitions. We are a regional owner-operator with a footprint in Georgia and Florida. I'm based here in Atlanta.
Matt Petrillo, Managing Director of Investments for Blackfin Real Estate Investors, owner-operator of workforce and attainable housing, approximately 10,000 units across the East Coast, primarily concentrated in the Mid-Atlantic and Southeast.
There's sound check. Oh, here we go. Judah Fuld here, VP Acquisitions of Viking Capital, multifamily owner-operator. We've transacted about 5,400 and change units, mostly in Atlanta, also in Texas and the Midwest as well, and a Mid-Atlantic holding to add to that. Market rate only, and while I originally started on the legal side of the equation, been on the acquisition side for about 7 years now.
And I'm Billy Haddad. I work at Partners Path Capital. We're a family office based in New York. Unlike the last panel, we do actually own property in New York. And then across the country, we're also a co-GP for local sponsors. So I see the population for our panel went down a little bit because people don't want to talk about distress stuff. But I guess I'll throw it to you guys. But my perception so far has been there's a lot of talk about distress, and there's a lot less distress to be found. Maybe it's hiding, but start with Anthony. What are you seeing out there? What's your sense of the current distress in the market?
Yeah, I mean, that's been our experience so far as well. I mean, from what I read a report recently that said something along the lines of, of the loan maturities, happening in 2024, 40% of them rolled over from 2023. So I do think there's been quite a bit of extending, modifying, and kind of kicking the can a little bit. So I think that might have something to do with why we haven't been seeing as much distress.
Yeah, I think that's generally right. And distress is kind of a squishy word. The stuff that we've seen that's distressed, so to speak, I think in a lot of cases, you're not really getting, you're kind of just inheriting somebody else's problem, so it's not really an attractive, risk-return profile, even if the basis, face value feels right or seems to be attractive. I think when you dig a bit further, you see how many issues a lot of these, more often than not, or at least what we see, kind of older vintage assets are quite troubled operationally or otherwise. So I think that while sellers' hands will continue to be forced, folks will be motivated to make decisions they otherwise might not have had to, given a variety of issues from other portfolio exposures, redemptions, financing. I wouldn't say we've seen that much, and remains to be seen how much we will ultimately see over time.
Yeah, not to echo too much. I mean, we've seen a lot of groups looking for distress, right? And that comes from, if you go back to COVID, right? A lot of the private lenders, the bridge groups, they basically went full on pause during COVID. They didn't know what was going on in the market. A lot of people didn't know what was going on in the market. All of a sudden now, properties are as occupied as ever. Multifamily proved to be a very resilient market during COVID. Now they want to jump back into 2020. That's when bridge debt got cheap. But then again, agency financing was also cheap. So it got cheaper. And then kind of Q1, Q2, some groups started doing bridge debt at these very low rates, whereas they were 5, 6, 7, 8%. Now they were 2.5%, 3%. And if I remember correctly, if you look at the numbers, the big wave of bridge debt that went into the market was really Q3 of 2021, right? The predominant structure for those loans are the 3-1-1s. So you have a lot of the big wave of bridge debt that everyone's waiting to come due to hopefully bring some distress, hasn't really matured yet. Q3, which is coming up pretty soon, is when people are kind of anticipating, will there really be this wave of distress? So haven't seen much yet, but what we have seen is kind of some distressed operators, some distressed groups who haven't been able to raise the equity, and that's where we've seen some opportunity, but not this big wave that everyone's kind of been anticipating and hoping for. While no one wants to see blood in the water, they want to see opportunity.
And, I know in the questions they had on the website, one of the things was, are you busting out your 2008 playbook? And, there's not a ton of gray hair on this panel, so I'm not sure how many people were here in '08. But, what's your game plan, right? So let's say Judah's kind of data is right. And so in Q3 of 24, you see a lot of these 3-year loans, coming to the end of that first phase. Presumably if it's a 3 + 1 + 1, they're +1ing and kicking it out. But what's your game plan for each of your firms as you see that coming down the track and preparing for it?
Yeah, no, happy to start here. So I would say, well, one difference I've seen between kind of the '08 playbook, which we see as '08 through really 2014-15, is that the lenders themselves really underwrote real estate much more conservatively on this go-around than they did prior to the Great Recession. And it's really the sponsors, the owners, who kind of bid up the market to where it's pretty frothy to the pricing that may incur some distress the next couple of years. So we don't expect there to be the same lender distress. We see, if you think about it, deals right now, we're seeing the market trading at about 80% to where they were being offered a couple of years ago. Unsurprisingly, a lot of those high leverage loans were at about 80%, right? So we don't think there's going to be a big discount to debt, but we do think there'll be an opportunity to talk to lenders and see, hey, what deals will be trading at their debt and kind of what basis that makes sense to then, as NOI goes up, your kind of yield on debt, your yield on cost will be kind of advantageous going forward.
Yeah, I mean, the interest rate environment higher for longer. I mean, we're kind of resetting here, and we can all, debate what, when we find the bottom, if we found the bottom. I tend to think we generally have, but this is kind of the new reset here for the new normal, and higher for longer, and the free money that was going on for quite an extended period of time post GFC created a different environment, lending and otherwise, and we're dealing with quite a few macro and micro issues, right? Everything from rates and inflation to then more specific micro issues of insurance, collection loss, which is unprecedented, particularly in places like Atlanta here, supply headwind. Also, I think, the way we look at and we're underwriting, certainly trying to be patient with our investment activity and where we're leaning in. I would say that we're also especially cognizant, not just of kind of a basis buy, and that's not a basis that, is a discount to peak pricing necessarily, which were aspirational, if not fantastical levels, but also 5, 6, 7 years ago. So kind of pre-COVID and where things were, particularly for secondary and tertiary markets, and making sure that we're triangulating and calibrating there. But making sure that the headroom and rents, particularly for the attainable and workforce product, in a lot of these stronger Southeast Sunbelt markets that ran up quite considerably, making sure that you pass the sniff test there and that there's enough headroom to continue without making otherwise affordable product unaffordable for a lot of the renter segment that we rent to. So I think there's a lot of component pieces to consider here, as you triangulate what makes a good buy in today's market, and what's ultimately going to be something you're happy with in 3, 4, 5 years' time.
Yeah, I think the biggest thing is, I don't think a lot of the distress is going to look like, 2000s product, really well-located deals with loan assumptions and really good markets. I think a lot of the distress is going to be, more challenging deals that, maybe there's not as much liquidity for, there's not as many people that want to buy these kinds of assets because they're more challenging to insure, more challenging to finance. So, we're trying to be opportunistic. Our box is sort of 1980s and newer, so we're trying not to stray too much from what we would otherwise be buying just because it's, a distressed and exciting opportunity. So we're trying to be active. It's just challenging when year one returns are not the most exciting right now. So, having conviction today when we kind of know, okay, the basis that we're buying at, the basis that some of these deals are trading at, it's very intriguing when you look back a couple years. But it is hard to have conviction. There's not as much equity available right now. It's more challenging to finance deals that have hair on them. So we're trying to stay patient, do more of the same, but I would love to be more active as an acquisitions guy. It's just it's been tough to find stuff that makes sense without kind of compromising some of our assumptions.
And building on that point, in the Southeast in particular, are you seeing more opportunity in kind of those secondary and tertiary markets, or even sub-markets within larger markets? Because at least what we were seeing kind of in that pandemic era, right, was basically every market in the U.S. started trading at the same cap rate, right? Because people were just chasing yield in a zero yield environment. And so now are you seeing those kind of cap rates right sizing where core markets price at one thing and then there's a spread to the secondary and there's a spread to tertiary, whereas in 2021 everything was just flat across the board?
Yeah, I can take that. I've definitely seen a little bit of a divergence in cap rates across asset quality in particular, and then market quality as well. I mean, for a long time, everything traded, like you just said, at a 4 or 4.5 cap, no matter if, aluminum wiring or 2024 construction or whatever. Although I do think the majority of the distress that we've seen so far in the large portfolios that have been distressed have been in slightly bigger markets, because I do think that's where people sort of almost more so got over their skis and got a little bit more excited about Charlotte or Raleigh or Atlanta, and sort of overlooked, the fact that not all submarkets in those cities are created equal. They're all different for different reasons. Some are more challenging than others. So we've actually seen a lot less, we own a number of small secondary markets, 100,000, 200,000 population. We've seen a lot less distress in, say, Savannah, Georgia than we have in Atlanta, or just on a percentage basis. Obviously, there's way more deals in Atlanta, but I can't really think of any deals that are truly distressed in like Valdosta, Georgia, or Savannah, but I can think of many, many large portfolios in Charlotte and Atlanta and some of these larger markets.
And do you think supply is playing a big role in, like, right, in the Atlantas and the Charlottes, right? A lot of people went in the ground and said, hey, we could build all day here. Whereas in the Savannahs and the Valdostas, people were a little more realistic with where they could take supply, or?
Yeah, I think it's a little bit of both. I mean, at the end of the day, there's definitely a lot more building, and there is a lot more building going on in these larger markets. So I do think that's a risk that deals in smaller markets don't have as much as they do in certain pockets in larger cities.
Then I guess building on that, I feel like you come to conferences like this and everyone for the last 12 months has been talking about how the market's at a standstill. What are you seeing, like, when do sellers crack, right? Because I think in a lot of cases, buyers are sitting on the sidelines going, I can't make sense of these cap rates with what I'm borrowing at. But when you've seen sellers transact, what's been the driving force of the transaction?
Yeah, so we look at well over 1,000 deals a year, right? We have a whole team, pouring through T12s and rent rolls and trying to find deals that work. So, and then we monitor the ones that have a call for offers, have a best and final, and then we follow up incessantly with the broker as to what actually happened. Because we're finding that a lot of deals that are being put out there aren't necessarily trading, not selling. The ones that are selling have really one common theme in them, on the value add front, that is. And what we're seeing is a massive value add component. So some of the deals that we're losing out on, groups are going in and saying, what, on a 5-year hold or 7-year hold or maybe even longer, there's a ton of value that we can add here. And on an IRR basis or an equity multiple basis, they're very comfortable. Because the reality is our challenge is that on the cash flow out of the gate, little to none. And if you're a group whose equity can stomach less cash flow earlier on, there are deals out there with tremendous value add potential. And the fact that you're negative on leverage out of the gate, they may be able to take those knowing that they'll be fine in the long run. We have trouble with those. So I'm seeing a lot of the deals that really have a massive value add component, larger deals where maybe it's each unit has a smaller value add component, but the aggregate it's meaningful, or just really classic deals in Atlanta or other markets in the Southeast that maybe have not been as touched, where they feel, you know what, buyers are willing to come to the table, again, not us necessarily, see that really large value add component, know the deal's going to work on an IRR or equity multiple basis, even though kind of the first 18 months, they may not see much cash flow from it. So those are the kind of deals that we're seeing most commonly get to the finish line, get awarded, and close without any hiccups.
Yeah, loan assumptions are definitely helping to bridge the bid-ask a bit there, and that continues to be the case. And the more IO, the better. So that's definitely a component piece, because there's still residual sensitivity to negative leverage. Maybe you'll fly in the face of that to an extent, or you can bring capital to the table to lean in to take 6 or 12 months on a newer vintage, let's call newer vintage, kind of, early 2000s and newer, late 90s and newer 9-foot product, so less functionally obsolete. That older product, what we're seeing and where there's been a challenge, even where it's ripe for value add, operational, physical, and otherwise, the basis creep is real on some of the older stuff. So the 70s, 80s, early 90s on your third, fourth turn, all of a sudden you're underwriting something that, at purchase feels right, but then you're putting 20, 25 a door into it, and then you have to exit it, at a, 200 plus a door for older product in, outer ring, primary or secondary, or even stronger tertiary markets. That's a tougher selling point. That's been a tougher underwrite to make, and, coupled with all the other, headwinds and components that you need to check boxes on, right? It's more boxes checked for capital for our partners today, I think, than ever before, and all it takes is half a box, to miss or not to be able to check to kind of talk yourself out of doing something. And then I think the final point about, at least year to date, there's something that we've seen, unfortunately continue, is just a lack of inventory. There's just not that many deals out there. There's a supply-demand imbalance in terms of the capital looking at deals and chasing opportunities relative to the universe of interesting opportunities that are available, is marketed and off-market. Off-market, either it's out of the realm of achievable pricing. Marketed, there's just not as much scarcity premium. So it's been tough sledding.
Yeah, I feel like that's an interesting point about. I think Judy said that. A lot of, and we've seen it, a lot of deals get listed, you underwrite it, you submit your offer, and then you go to the broker, and you're like, hey, so what happened with that deal? And they're like, they didn't transact, right? And I guess to your point before about the Q3 loan maturities, right? It seems like a lot of sponsors are like, hey, we got a problem coming up. Let's test the market, see where it's at. They don't like what the market says, and they just sit on it. And to your point, then there's not a lot of transactions, right? Everyone's just kind of sitting around. So I guess what's been keeping the three of you the most busy these last 3-6 months? It sounds like, everyone's looking for the distress. We're talking about it, but, in the absence of that hitting the market, like where are you the most active, or are you not that active, either way?
Yeah, I mean, like I said, we would like to be more active. We bought a couple deals last year at the beginning of 2023. And we've been busy looking at everything on the market, and there hasn't been that much. But like Judah mentioned, I mean, we're a small team. We've underwrote 600 something deals last year, and we try to look at everything, even if it's not a perfect fit, just to get a better understanding of what's going on in the market, and procuring different kinds of data and trying to learn things for asset management as we look at other people's deals. But it's kind of getting ready, making sure things are taken care of at home. I mean, we're a small team, so we're making sure all is good in our portfolio, because I think very rarely, you'll see in a distressed market someone who is distressed as a seller also in the same market being a buyer. So we just want to make sure that we're able to kind of take advantage of, even if it's just more inventory in the near future, kind of a more normalized environment. We don't have any challenges, within our portfolio. So spending time getting out of different bridge loans, and thankfully there's not many of those situations in our portfolio. And then just trying to continue to be a market participant, because I think, slow times like this definitely kind of weed people out of the business in some cases, and we want to be there when things normalize.
Yeah, tide's going out, right? On
Totally.
Yeah. I mean, we were fortunate to transact in 7 deals last year, and probably 5 or 6 more deals we thought we'd do, and maybe 6 or 7 more than most people, but they skewed smaller. We do touch and play in the LIHTC space, uppercase A affordable. It's about 20% of our portfolio today, so it's a space that I think is not coincidentally kind of attractive at this point in time, given the life cycle of a lot of those LIHTC programs. Nobody's building it, so those represented more than 50% of what we bought last year. They're typically a part of, but not the majority of what we close in a given year. So that was helpful, but definitely a lot busier than we are productive, or from a normal year standpoint. But I think just being patient, definitely actively asset managing and monitoring our own portfolio, using information and data from that to help inform what we're seeing and trends that we're identifying in new acquisition opportunities, staying in front of folks, bounce backs, participating in the market, to your point. Everybody appreciates that, and we ultimately are all in this together, right? I mean, sellers are buyers and buyers are sellers, and being a proactive, borrower, maintaining those relationships, and protecting those. So it's definitely no shortage of things to do, just a bit less productivity, unfortunately.
Yeah, for us, the deals that we've been able to transact on, so we closed 3 deals last year, which again was a slowdown but felt like an accomplishment. And we have 1 deal under contract right now. And kind of what you've heard up here so far, we've had to basically check 2 or 3 of those boxes of what makes a deal work in order to get a deal across the finish line. So we closed a deal 2 weeks ago in far north in the Atlanta MSA, where it was a sponsor was awarded the deal, and their equity fell through, right? They had an institutional equity partner, the only one who was really interested in the deal, and when they fell through, they just kept on putting money hard and extending and hoping. And because we share a property management company, we got the introduction made to us. So do you want to call it distress? I don't know, but certainly they felt distressed.
That's distress.
Right, sure.
Well, checks the box.
So we were able to step in, and again, that was one that just due to timing and rates ended up becoming a better yielding product. We stepped in late, had a lot of DD already finished ahead of us, again, with the same PM team that we typically use. So we were able to really get comfortable very quickly. That was one opportunity. Another one was one kind of mentioned earlier, yield in secondary markets. So we were able to close a deal in South Bend, Indiana. It was better yield, again, a 6 cap, because not everyone's looking at South Bend, Indiana. Also, as a loan assumption, we blended at 70% LTV at a 4.12. And again, it was really more of an operational play and newer vintage. So the deals that we're seeing get across the finish line, as kind of everyone up here has said, need to kind of fit a couple of these profiles, and if you can fit 2 or 3 of them, those have helped. The other thing I'll say is that we're seeing, again, we have marketed 1 property for sale that we didn't sell, so we've been on that side of the equation. But one concern a lot of sellers have, and I hear from sellers directly, heard from a lot of groups here I've been able to meet in the last day and a half, is surety of close. You know, a lot of groups are willing to kind of offer high pricing with the hope of retrading, or with the hope of just winning a deal and figuring it out. And 3 of those deals I just mentioned, we were not the highest bidder on. We were the second or third group, but we had a relationship with the seller, or we had enough conviction from the brokerage group that we actually got awarded the deal at the 3rd or 4th price, which was unheard of 2.5 years ago. So just to show you, stick to your guns as to where the deal works, and reputation really is king. Pricing was king, I say 2.5 years ago. Reputation, I think, together with close pricing, I don't say you're going to come in that cheap, really can help get you a deal when even the broker might not say, you might try to push you up, so you're not the highest price, have some conviction, because if you can back it up and if you have that track record, that can really swing a deal in your favor.
Yeah, I mean, these points in the market, right? When owners are under some kind of stress, time to close is very important, right? And surety to close, right? Where, maybe it's not this deal they have a low maturity coming due on, but the other one requires capital going in, and so they need to close with Judah so that they can, reallocate that capital. But it does seem like, you're saying that, both of those deals have a bit of a story to them. Mm-hmm. And it seems like in the current market, it's only deals with a story that get done, right? That there has to be, the broker calls you and no one's like, hey, I have X cap rate and X market, are you in? And people go, yeah, like people are not falling over themselves to get into that deal. And it sounds like we've touched on a few of the the stories, right? It seems like it's someone who has it locked up, but their equity's falling through because syndicators or people who are going around for small checks, it's a much tighter market than it used to be. It seems like some balance sheet issue, right? Debt's coming due, the refi's not going to work, it's a cash in. I guess there's operational, right? So I think, Matt, you were touching on, I feel like there's, at least in the Southeast especially, there's so many of these deals who are now on their third value add sponsor. And over those 3 hold periods, the asset has aged, and all of the quote unquote CapEx has gone into cosmetic things, and then you look, behind the walls, and you got massive kind of problems lurking.
Or you got to make sure that the juice is worth the squeeze, right? And there's juice left to squeeze, right? How much, again, have you hiked, rental rates and levels that went up considerably while we were in, this past cycle? What's left there? But I think it's just an interesting point, an important point in terms of the reset, in terms of priorities, transaction priorities, surety of close, timing, having your equity lined up, having an insurance, a credible insurance source behind you. I mean, we've never seen, there was always real estate tax adjusted cap rates. Now it's real estate tax and insurance adjusted cap rates, and probably will be for quite some time, if not going forward. So it's yet another, adjustment to consider. I think that folks are definitely more inclined to pursue the story. That's a huge box to check. Nobody really, or folks, even the bigger institutions that we speak to, are looking to fight nobody's looking for a fair fight, right? They're looking to find some element, some component, either existing ownership in a pocket, some significant forthcoming announcement and or competitive advantage that sponsor/buyer, team group has in or around that market location, or can, help to drive the opportunity and create value, right, beyond just what everybody else is underwriting.
Yeah, I think you made an interesting point about rents, right? And it's similar with cap rates, that not all rents and cap rates have equal risk, right? That you can step into some deals and, someone gives you the trailing 12 and you look at it and go, yeah, I'm going to sleep well at night knowing that these rents at renewal are always going to be there. I can underwrite some, inflation growth, nothing crazy, and never have to worry about it. And then there's other ones, you get the T12 and you're like, oh man, we're going to be on a wild ride trying to hold these rents in the current market. Depending on where in the Southeast, right? If you have supply coming online, people, at least I've heard in some Texas markets, 3 months free. It's like New York during the pandemic, right? Kind of levels of concessions, and, contrary to popular belief, tenants bake that in. It's not like, oh, great, now I have a 30% rent bump. I'll just renew, easily.
It doesn't snap back like New York.
Yeah. Fortunately, in New York, it's been just people just forgot about 2020, 2021 leasing seasons. And then I guess one thing I wanted to touch on is, maybe there's someone in the crowd, they're kind of in a distressed situation themselves, right? So we've talked a bit about people who bought in 21 at very low cap rates, big rent assumptions, very little insurance increase assumptions. Right, and so they're in a distressed situation. They're looking at Q3 and they're a little nervous. What's your, what piece of recommendation do you have for them, as to how to manage that situation in kind of the most effective and positive way for them?
I'm happy to jump in here. So one thing I think we were hesitant about, but we got over this, and it's we're early on. We have a couple properties with this refinancings coming due, and even though we're not worried about the refinance, we just recognize that in this environment, this is a different refinancing environment than it was 3, 4, 5, 7 years ago. So one thing I would say is don't be afraid to have a tough conversation with your lender. They're very aware of the current environment, and asking, we called up a couple of the brokers on the deal, and we always get BOVs every 6 months on all our properties, and say, hey, we need the BOV, but don't try and convince us to sell it. We're not selling it right now, right? Give us the most real BOV you can, and don't be afraid of giving us a low number. Brokers always want to
act like you actually are buying it. Don't tell me what you hope someone else will pay for it.
Right, because the idea is as the lenders start to understand, if you're in a situation where you're afraid you won't be able to extend, or you're afraid that the lenders might come down hard on you for not meeting certain tests you have in your loan, getting them to understand that their own principal might be at risk. is something that is a hard conversation you might be afraid to have, that could actually be a big asset.
Well, they've probably had it internally, right? Like
Right.
if they have a good credit function within their bank or lending group, they every quarter or 6 months they should be running through the portfolio going, uh-oh, like we could have a problem here. How are we managing it?
Yeah, and if you prove that you're an owner who's willing to work through it, then they're looking for good partners. We had someone reach out to, we had one of the lenders on just an annual call, thank us for making the loan payments. And I said, I'd never been thanked before for making loan payments. And the response was, we have a lot of groups who aren't.
Yeah.
So the threshold is very low to prove to be a good partner with your lenders.
Yeah, and I think after the '08 crisis, right? I think a lot of groups came out of that with amazing lending relationships when they did right by the lender in addition to themselves. And I think when you hit those massive recessions, it also creates opportunities because lenders go, hey, Judah treated us well. We're taking this property back. We trust that Judah will do right by us, and we can kind of work with him going forward.
Similar to piggyback off of what Judah was saying, I think the summary takeaway for us, be proactive with your lenders, play the long game. This is a cyclical business, and people remember, and be realistic with your expectations, both on the sale and on the buy for that matter.
Yeah, I think proactive communication, just good business principle. Not just with your lender, but with your equity, no matter what your equity source is. Our equity is, a large pool of high net worth individuals and small family offices. So sometimes it's challenging to communicate with hundreds of people, but, you got to make the calls if you've got something going on that you are trying to solve. And then I would just say, think about all your options. There's a lot of interesting, creative ways. I won't delve into all the different things I've seen people do with tax abatements and all kinds of things to sort of get over the hump and get refinanced or kind of live to fight another day. But some of the, most prolific owners in the space, had challenges, and you hear stories from, the great financial crisis, and it's, live to fight another day, just keep, just figure out how to keep the asset. And, that's generally kind of our thought. Thankfully, we're not dealing with that in any situation at the moment, though.
Yeah. That's what we've seen is, I think groups are also sometimes too cagey, right? Where it's, they have a problem in their portfolio and they're trying to like hide it from the world instead of, reaching out to capital providers and saying, look, this is where we're at. Can you help, right? What's the solution that you might be able to provide? Because kind of the more information you provide and the sooner, the more you can, there's the old saying, how do you go bankrupt? It's slowly and then all at once. Okay. And I think that a lot of sponsors keep kicking the can, but the can keeps getting heavier and heavier and heavier, and then you're not going to be able to kick it. And so, the sooner you can kind of solve it, or the more options you have, the better the outcome's going to be. And I guess, do any of the three of you, do you play outside of pure equity, or are you guys all just kind of in that equity space?
Just equity for now.
Just equity. Yeah, no, because we've been doing, trying to do pref or mezz or kind of other lending type products, and I feel like every group we talk to, we give them a quote, and then they turn around and either they go to their LPs and raise the money on those terms, or they kick it in. And so it's been interesting. I've been wondering if at some point that capacity is going to run out, and there's going to be more mezz and pref opportunities out there, because if your thesis is I'm in trouble today, I just need the Fed to treat me right and lower interest rates, and then I'm all set. Like, those are solutions that might make sense for a lot of sponsors.
So we've taken on pref equity investments on certain of our deals. It fits certain, it doesn't fit other ones. I always say and I used to work in the capital market space where we first met. There are two reasons groups will take on pref equity. One is because they just need equity. The other is because it actually, when your deal's good enough, it offers you leverage as compared to LP investors. So we'll take on pref equity. We also this year launched our first ever pref equity kind of vehicle. We did have a bunch of smaller owners who came to us kind of in distressed situations. They either needed to refinance, they had to pay down their LTV in order to extend their loan and not refinance, or they just had they had used so much of their capital that they had raised in order to fund their debt service. They no longer had the money for the CapEx. So we saw, but there were small checks, right? A lot of the pref lenders, they have $3, $5, $7, $10 million numbers. That's the minimum they'll put out there. So we actually kind of, after being borrowers for a couple of years, went on to the lending side on a pref equity capacity to put out kind of smaller to other groups, similar to us. We have the capacity, if we ever had to take over a property, we have the structure in place to be able to do so. But really, we could understand the situation, see where their need was, see where maybe on a risk-adjusted basis, a good opportunity. So we've now been actually on both sides of that pref equation.
What does that tend to price like, some of the deals that you did, and what are the leverage points that you participated?
Yeah, absolutely. So, I mean, on the borrowing side, pref dollars now, we've seen range anywhere from 13% up to 17%, depending on some of the groups we're typically borrowing from, we see them tap out at low 70s, but that's where their pricing is closer to 13%. There are groups that'll go take up to 87%, even 90%. We see them pricing 16, 17%. So it's on kind of a risk-adjusted basis how they do it. And on the lending side, we're putting out 14, 15% money. Again, much smaller checks. And the current pay is also something to focus on because obviously that's going to constrict your cash flow.
So it looks like we have a question, and I was actually going to ask a similar type of question, so let's try this. If a crystal ball, 6 to 12 months from now, we're back here, and you guys are like, wow, I have been so busy these past 6 to 12 months. If I asked you, okay, what deals did you close the last 6 to 12 months? Today, as you sit here, what do those deals look like? What have you been busy with? And with the different, hold period, cash IRR, different question in the question.
Right, we're typically, I think just broad strokes, right? We're typically underwriting a 5-year hold, and things that are attractive are some of the characteristics we've touched on. But the story, right? I think that neutral to positive leverage, certainly keeping it as close to or in that range. True demonstratable value add upside. Leaving meat on the bone. We usually underwrite, over the course of our hold, doing what's necessary to kind of create value, if not reposition, but not doing everything. We're still definitely very much in a project level, high teens. Obviously, if you can get more, great. Kind of for the traditional value add, total return, high teens, levered return levels. And the cap rates are a little bit of a moving target, but if you can go in again close to that neutral leverage point, that continues to be a focus. And basis right? Pegging a discount, like we said, not just peak pricing and replacement cost. Granted, everything should be a discount to replacement cost. Otherwise, you shouldn't be buying it today. But also looking back at 5-6 years ago, right? Looking back at 18, 19, early 2020, and understanding for a lot of these markets, not just the outer ring primaries, but particularly the secondary or tertiary markets. Where were things trading then? How to bridge that delta or understand it.
Yeah. For us, I think it's, finding assets with shorter term upside that we can create, but that we're comfortable holding, for a longer period of time if we have to. I think it's a late cycle lesson that everyone is kind of in the process of learning that, a 3-year hold or underwritten 3-year hold is a lot, has risks to it. So I think it's just, being capitalized up front, having the right debt and equity to potentially, hold for longer than maybe we otherwise would want to. And that for us is, over 5 years. But yeah, I think we just want to be in a position to take advantage of, whatever opportunities are on the horizon.
Yeah, it's a good point about how a lot of times you see deals and they've shortened the hold period so they can jack up the IRR, and then people miss out on how much risk is inherent in that whole business plan, because if you don't time it perfectly, you're going to have a tough time.
That's right.
All right, so what are some unconventional ways to find my first 50-unit complex here in Atlanta? I I think you guys probably play in slightly larger properties, but I don't know if there's any insights you guys have.
Yeah, listen, the Atlanta multifamily world specifically has a very robust and active kind of broker community, covering everything from 600-unit institutional properties to kind of the more private capital, middle market, or even, sub 50-unit properties. The challenge is that those brokers themselves are using conventional, what they would call unconventional ways to find those same properties. My advice to someone looking for that first 50-unit building would be that a lot of owners, especially I think in the smaller units, right? These people haven't necessarily made a killing in real estate, right? They have smaller assets. They usually have owned them for a longer period of time. And the benefit is that they don't necessarily like brokers. And if people are cold calling them or looking them up or pulling the TREP list as to what loans are coming due, they may really enjoy a cup of coffee with someone who's looking to do what they did 20 years ago now, whereas they don't really want to be one of 1,000 people on a list of a broker. So I would say try and meet those smaller owners. I wouldn't focus on a property, I would focus on an owner and see what they're willing to maybe part with, as opposed to trying to force them to sell one asset, because you might be choosing their favorite asset when they might have another one they want to sell. So I would say on the smaller side of things, and this is coming from a former broker, and I was not a very good broker, but I was in that world for a little bit. I noticed that the trouble I had was on that side, competing with people who were just, hey, they can relate to another owner, they don't want to talk to a broker.
Yeah, I mean, I feel like if I'm reading into this question a bit, it's probably also someone who's from Atlanta. My recommendation would actually be don't limit your pool to just what's listed, right? Like, you live here, you probably have a thesis on a particular submarket, you probably maybe even live in that submarket. So I remember we looked at a self-storage deal recently, and the self-storage developer was like, until you look at a self-storage deal, you don't realize how many self-storage facilities there are when you just drive around. And I think you'll notice the same thing about multifamily buildings. Like, if you drive around whatever neighborhood you live in, I bet there's 5 or 6 apartment complexes that are 50 units or less that you never even noticed. And so I think to me, the first place to start is whatever locus point or submarket you think is a good place to put your money, just spend an afternoon driving around, or go online, if you want to do CoStar or some other repository of real estate info, and just say all right, where are the 50-unit buildings here? And to Judah's point, call up a lot of those smaller ones. There's some old-time owner who even if they're not selling their building, they'll introduce you maybe to the right property management firm, or maybe they'll help you property manage, because if you're also starting out property management, I mean, we property manage our buildings in New York City, and it sucks, right? For anyone who's done it, it is a 24/7 slog, but it's a necessary evil, if you will. And I think that's always you go on social media, everyone's like, oh, mailbox money, it's so easy, you don't have to do anything, just money magically appears from your real estate investments, and that could not be further from the truth. So as you engage on that first 50-unit, make sure you're being realistic as to the time investment that's going to require you.
So on the distressed opportunity, I think Matt has said, obviously some of these distressed have issues, that. If you took one and you tried to value it, just maybe briefly explain, I'm going to have to inject X million, this much deferred maintenance, it's going to take X amount of time, I'll take that chunk and then ask for that discount. How do you go about seeing if it does make sense?
So just to repeat it so everyone can hear it, the question is, in a distressed scenario, basically, how do you value the asset, accounting for any kind of necessary CapEx or other capital injections that are required? Is that fair?
Typically, you're going to have to carry the loss for X amount of months. That's going to be costing you whatever your equity is, or it's going to have to, So you go back and say to the lender, the owner, that's what a discount, then it will make sense, or you just,
Yeah, I mean, it's assuming you could finance it, right? It's assuming that's part of the program, and figure out how to bridge that depending on how much trouble kind of there is. You try and you lay the number based on what you see kind of needs to go into the deal. First and foremost, I think that there's a deal that's kind of correctable and fixable, right? So the juice has to be worth the squeeze. That's kind of the point I think I made before, is that it's not just inheriting somebody else's problem. There's somebody on the asset management team, and, we have different buckets. Everybody works hand in hand. We're a, small to mid-sized company. So while I don't necessarily work daily on the asset management, I am still responsible for what is asset managed. I'm bringing it in the door. So nobody wants to hand their asset management team, a Pandora's box. So the juice has to be worth the squeeze. The risk-adjusted kind of return has to be there. So you triangulate back into a basis based on what you believe needs to go into the asset, operationally to right size, to turn it around. So how long you're going to carry XYZ vacancy, economic vacancy, for example, in places like Atlanta with a lot of the collection loss challenges. It's not just the fact that, there's 10% physical vacancy, but you got another, similar amount of collection loss exposure. So all of a sudden you're running a 75, 80% economic vacancy, and you really need to think long and hard about how long is it going to take to right that ship, before I even consider putting CapEx dollars into and trying to turn units over and or address, any manner of CapEx issues. So, you back into what the purchase price is to get there at realistic exit assumptions, right? That's the other piece with the basis creep here. So maybe you're putting 40 or 50 a door in, and if it's available, 75 a door, just using numbers, and it's low 100s all in, you can't exit that deal or think you're going to exit it at 200 plus a unit, and that's what it takes to make the deal work. Then something's wrong in how you've underwritten it. So you got to triangulate those different points and make sure that you're getting paid for the risk you're taking, right? It's all about triangulating that risk-adjusted return basis.
And actually, I think it's our time. But I do invite you to continue the conversation afterwards. I just wanted to make sure Sam stays on time in the back. But thank you to Matt, Anthony, and Judah for your insight and time. And thank you, everyone.